A lot of people have been calling and asking what I think about the rates going down in September. People that are currently under contract that we've already locked in are asking if their rate's going to get better when the Fed lowers the rate here in September. And I wanted to explain what the differences are between the Fed funds rate and mortgage rates and how the two aren't directly related and how one does not influence the other and one is not equal to another, but how there might be a little bit of similarities between the two and how one might influence another. So let's talk about the Fed fund rate. I'm going to use a story to help explain what that is. Let's say that there are a group of children playing together in a sandbox, and each of these children has their own bucket, and they're using the sand in that sandbox to keep their bucket full. One kid might have too much sand in their sandbox, while another might be running low. So the kid with the extra sand can lend some of his sand to one of the kids that needs it, but they'll charge a small fee for the other kid borrowing that sand, kind of like renting it, if you will. Now, replace the kids with banks, the sand with money, and the sandbox with the Federal Reserve System. So the Fed funds rate is basically the interest rate that banks charge each other to lend money to another bank overnight. That's the Fed funds rate. Mortgage rates, on the other hand, are driven by three key components. Other things influence it indirectly. So things that are happening in the economy, the Fed fund rate, do influence mortgage rates indirectly in some of these other ways. Mortgage rates are driven by mortgage-backed securities, the 10-year U.S. Treasury, and inflation also plays a role. So throughout the day, like any other market, the 10-year Treasury is gaining momentum, losing momentum. The amount that the 10-year Treasury is out on the index is increasing and decreasing throughout the day, every day. So it's constantly a moving target. The same thing with the MBS, or mortgage-backed securities. It is a market condition that changes throughout the day, every day. So if you were to call me this morning and say, hey, here's my scenario to a T, what rate can I expect? And then you called me in the afternoon with the exact same scenario, that rate could possibly have changed over the course of a day. It certainly could have changed over the course of many days or a week or a month. But there is not a person, meaning the Federal Reserve, that's dictating what that rate is and increasing or decreasing that rate. Any questions, please reach out. Let me know how I can help make it clear for you. I want to be your mortgage expert. Let me know how I can help.